The room smelled of espresso and certainty. On a September morning in 2006, one hedge fund controlled so much natural gas that a single trader's screen could nudge the price of heating for half a continent. His colleagues called him untouchable. His firm had already booked profits that made rivals look like amateurs, and the man at the center believed the market simply owed him more. Within days, that same position would erase more money than most nations spend on their armies, and the fund that housed it would cease to exist. Nobody sipping coffee that morning grasped how close they stood to the edge. The numbers on the screen looked like a triumph. They were the outline of a grave. To understand how a winning genius walked willingly off a cliff, we start with the one number he trusted too much. His name doesn't matter as much as his method. Picture a young Canadian quant, sharp with mathematics, who saw the natural gas market not as weather and pipelines, but as a puzzle of spreads. Gas is strange. It must be stored, and storage is scarce, so the price for winter delivery and the price for spring delivery can drift wildly apart. Most traders nibbled at that gap. He swallowed it whole. He bet that winter contracts would rise and spring contracts would fall over and over in enormous size. When a hurricane season went his way, he printed money on a scale that stunned older colleagues. The bosses noticed. They handed him more capital, less oversight, and a nickname that hardened into a legend. Genius, unquestioned, is the most expensive thing a firm can own. The fund itself had a reputation for calm. It had been built to be diversified, a smooth machine spreading risk across many strategies so no single bet could sink it. That was the promise sold to pensions, endowments, and wealthy families who parked billions inside. But somewhere along the way, one desk grew louder than all the others. The energy book, driven by that one trader, began generating the lion's share of profits, and quietly, the lion's share of risk. When a strategy makes you rich, it stops looking like danger and starts looking like skill. The firm's leaders watched the gains and felt clever. What they didn't fully register was that their entire diversified empire had, without anyone deciding it, become a single leveraged wager on the shape of the gas curve. Remember the coffee-scented certainty of that September morning. Rewind to the year before, and you'll see where it came from. In 2005, Hurricanes Katrina and Rita tore through the Gulf, smashing rigs and pipelines. Gas supply cratered, winter prices exploded, and the young trader's positions caught the entire move. He reportedly earned his fund over $1 billion in a matter of weeks. Overnight, he became one of the highest-paid traders alive, a name whispered on trading floors from Calgary to Connecticut. But triumph teaches a dangerous lesson. It told him the strategy worked not because a rare disaster had aligned with his bet, but because he had cracked the market's secret code. He didn't get lucky, he decided. He got right. That belief was the falling knife he would soon reach for. Here is the original insight most retellings skip. Hunter's edge was never pure prediction. It was size. When you hold a position large enough, you don't just forecast the market, you become the market. His enormous winter-long, spring-short spreads could move prices simply because everyone knew he was there. Rivals traded around him. The spread widened partly because he willed it wider. For a while, this looks like brilliance, a self-fulfilling prophecy. But it hides a trap. A position so big it moves prices in your favor is equally a position you cannot exit without moving prices against yourself. The bigger you get, the more you need calm markets and no rush to leave. He had built a fortune that could only survive if he never, ever had to sell in a hurry. The bet grew grotesque in scale. By 2006, the single fund reportedly controlled a stunning share of the natural gas contracts on the exchange, in some months positions equal to the entire winter heating needs of large regions. Regulators would later note that its footprint in certain contracts dwarfed everyone else combined. The trader kept pressing, convinced that a repeat of 2005's chaos would deliver another windfall. He wanted winter to be scarce and spring to be glutted, and he wagered as if he could summon that outcome. Around him, risk managers saw eye-watering numbers but hesitated to rein in the man whose desk was carrying the firm. Fear of killing the golden goose silenced the very people paid to ask the hard question. What happens if the weather simply behaves? The weather behaved. That was the whole tragedy. No scandal, no fraud, no rogue lie. The winter of 2005-2006 turned out mild. Storage tanks stayed comfortably full. The hurricane season of 2006 fizzled, sparing the Gulf. Everything the trader needed to go wrong went boringly, mercifully, right for the rest of the world. And so the market's shape flipped against him. Winter prices, which he owned in vast quantity, began to sag. Spring prices, which he had sold short, refused to collapse. The precise spread he had bet his empire on narrowed, then inverted. Each small move against a position that colossal translated into staggering paper losses. The genius who thought he had cornered the future discovered the future's only rule. It does not owe you the disaster you planned for. For a few weeks, denial did its work. Losses appeared, then deepened, and the response was chillingly familiar in these stories. Double down. Rather than cut the position, the desk reportedly added to it, reasoning that the mispricing would surely correct and reward their patience. This is the psychology at the heart of every fatal bet. Admitting the trade is wrong means admitting the genius was ordinary, and ego will torch a fortune before it will accept that. But there was a colder problem than pride. The position was now so enormous that even if they wanted out, there was nobody on the other side big enough to buy it. To sell was to crash the very price they held. They were trapped inside their own gravity. The final week arrived like a landslide. In early September 2006, the natural gas curve moved violently against the fund. The spread the trader had bet on collapsed with a speed the models called nearly impossible. Day after day, the losses compounded, hundreds of millions, then $1 billion, then multiples of that. Margin calls thundered in. The exchange and clearing brokers demanded fresh cash to cover the shrinking position, and the fund had to find it instantly or default. The smooth, diversified machine that promised stability was now hemorrhaging so fast that its other strategies couldn't matter. In roughly a single week, the fund lost around $6.6 billion, a sum larger than the earlier long-term capital collapse. The empire built on one man's certainty was dissolving in real time on the screens. Then came the desperate rescue nobody outside finance ever sees. Unable to exit its monstrous position on the open market without triggering total collapse, the fund had to hand it off. In a hurried deal, it transferred the toxic energy book to a major investment bank and a rival hedge fund, paying dearly for the privilege of escaping. Think about that. The position was so dangerous that the fund paid others to take its winning-turned-losing trade away. It was the trading equivalent of paying someone to defuse the bomb you built. The transfer stopped the immediate bleeding, but by then the wound was fatal. Investors' billions were gone. The fund that had prided itself on prudence announced it could not continue. The Legends bet had not just lost, it had swallowed the whole house. The unwinding rippled outward. Pension funds and endowments that had trusted the fund's calm reputation woke to enormous holes in their books. A university endowment, retirement systems, and cautious institutions, the supposedly conservative money had been riding unknowingly on the shape of a gas curve set by one man's conviction. That's the quiet lesson buried here. Risk doesn't announce itself with warning sirens. It hides inside the strategy that has been winning, disguised as competence. The moment a single desk, a single trader, or a single idea generates most of your gains, you have already concentrated your fate whether you admit it or not. Diversification on paper meant nothing once every profit traced back to the same wager. The fund had been a one-bet firm wearing the costume of prudence. What became of the trader? He faced regulators who later accused the operation of attempting to manipulate gas prices, a charge that dragged through settlements and fines. But the deeper verdict was simpler and harsher. He had confused a single extraordinary jackpot with a repeatable law of nature. In 2005, the storms had aligned perfectly, and he had banked a fortune. He mistook alignment for mastery. The market had rewarded him precisely enough to destroy him, feeding his conviction until it was large enough to detonate. That is the cruel arithmetic of the fatal bet. The win that makes you a legend is the same win that plants the certainty that ruins you. The bigger the earlier triumph, the more catastrophic the encore tends to be. Step back and the whole arc snaps into focus. A brilliant mind, a real edge, a genuine early triumph. And then the slow poison of believing the triumph was inevitable rather than fortunate. No forged documents, no fake tankers, no phantom accounts. Just a titan at his peak making one arrogant wager that the future would repeat itself on command. It didn't. And in a single week, $6.6 billion in one of the market's proudest funds simply vanished into the shape of a curve. The espresso in that September room had barely cooled before the whole thing was gone. The most expensive words in finance were never a lie. They were three quiet ones. I can't lose. And the men who believe them are always the last to see the knife. If this story gripped you, understand that it is one of dozens where a single arrogant bet unmade an empire. And we tell them here every week, cinematically and carefully documented. On Bull and Bust, we dig into the frauds, the crashes, and the fatal wagers that history quietly buried so you can watch overconfidence collapse in real time from a safe distance. None of this is financial advice. It's the human story behind the numbers. Subscribe now and turn on notifications so the next collapse lands in your feed before everyone else is talking about it. Ask yourself before the next video begins. How many empires right now are riding on one man's certainty, sipping their coffee, absolutely sure they cannot lose? Hit subscribe and let's find out together